We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. This week, I am sharing an interview I did on my friend Jesse Cramer's podcast, where we talk a lot about not just what's been going on in markets recently, but how to think about markets for the rest of 2025. We think about some of those concerns that have shaped the faith of some people in long-term investing in general, and we talk about what if we have our third recession in 20 years. There's a lot of stuff that we get to in this interview that I think you'll enjoy. And because I had just turned in my manuscript when we were doing this conversation, I think there's a lot of concepts from the Perfect Portfolio that show up in it. And if you want some exclusive updates on the Perfect Portfolio, you can find a link at the top of the episode description or visit theperfectportfoliobook.com. And now here is my conversation with Jesse Cramer.
Today, I'm really excited because Peter Lazaroff is back and will be joining me. Peter is the Chief Investment Officer at PlanCorp, and he's the host of the Long-Term Investor podcast. Peter is routinely recognized for simplifying complex investing and planning issues for clients and for listeners. He's been repeatedly named a top 100 U.S. financial advisor by Investopedia. He's always a great resource for teaching people about investing, and you'll see that today simply through the frameworks and explanation that he provides. Peter first joined me back on episode 77 of this podcast. Go ahead and listen to that one. And now he's back for round 2 today. Peter, it's messy out there, man. We've had an interesting year so far. We're recording in mid-June. This will probably publish in mid-July. We started on some highs. Boom, April hit. We had some lows. Now maybe we're back towards highs. But still, one thing I'm struck with is there's this big difference between short-term signals and long-term direction when it comes to investing. I'd love to maybe start with just how have you felt and what are some of your thoughts about how 2025 has been so far?
Think about being a long-term investor is that when you go into a year, clients are always talking about a few things, and tariffs were certainly on people's mind. The election results had just come in, and I would say in any presidential election, my experience has been that half of people are very upset and half of people are happy. And I think a lot of people who were upset were saying the market is going to crash. I don't like some of the policies and things that are being said on the campaign trail. And lo and behold, I wouldn't call a 20% drop a crash, but we had a near 20% pullback, and you have people who feel validated. I can't tell you how many times in my career I've put up slides showing that who is president does not impact the stock market, or a political party does not impact the stock market. So one frustrating part about 2025 is me now realizing in about 3 years when we have our next election that when I put up those charts, people are going to say, well, what about the tariffs that Trump put out there? That did happen. I suppose that validated. But as you mentioned, we're already back. It's a great reminder that the market is going to fall 10%, 20% with a pretty surprisingly large frequency. And the story is always going to be different. But the most important thing that I was talking to clients about and talking to employees and friends and family is earnings. Yes, in the case of tariffs, which, by the way, by the time this airs, that 90-day pause will be close to expiring. And so there'll probably be more headlines related to it. Here's the thing is, no matter what the tariffs are, do you think McDonald's is going to try to sell less cheeseburgers, or Coca-Cola is going to try to sell less Coke, or Ford's going to try to sell less cars? No, they're going to try to sell as much of their product no matter what. Will there be more obstacles? Have the rules to the game changed? It's like if we got out a board of Monopoly and we've been playing by the same rules that Monopoly has always existed with, and suddenly we change some rules, it's going to change your strategy a little bit. But when you invest in the stock market, you are betting that CEOs like money and that shareholders will demand that CEOs maximize their value. So 2025 has been a full long-term market lesson all wrapped up into 6 months. It'll be really interesting to see what goes on with tariffs, what goes on with the spending bill.
I want to play devil's advocate here on behalf of the listeners, but also, Pete, on behalf of client conversations that you and I have both had. Maybe someone's listening right now and go, okay, we don't know what will happen over the next month between when we're recording and publishing, but let's say the S&P stays about where it is right now, which is close to all-time highs. We haven't really lost any ground on the year, but imagine someone says, I hear what you're saying, Peter, McDonald's will keep on trying to sell cheeseburgers, but we saw something this year where one politician was able to push some policy forward and then pull it back and then kind of push it forward and pull it back and just whipsaw the stock market. And that has fundamentally shaken my faith in long-term investing. Is there any merit to that argument? What's your response there?
I think there's merit to that feeling. The feeling is valid. Feeling concerned, feeling worried, feeling uncertain, all valid, all normal. Nothing wrong with that. When you take a step back and you think about why we invest in the first place, I always go back to really the first principle level is we invest because we're trying to grow our savings faster than the rate of inflation without taking undue risk. What is undue risk? Yes, there is risk in that concern and that feeling that one individual specifically is exerting a lot of influence over the short-term fluctuations of the market. There is a risk that the market will fall 10% roughly on average every 12 months, because that's what it's done historically, and fall 20% every 3 to 4 years on average, because that's historically what it's done, and fall 30% or more about once a decade on average, because again, that's historically what it's done. I generally think that when I'm investing in stocks, I'm going to assume that we're going to have downturns with a similar magnitude and frequency as we have in the past. To me, that's not an undue risk. That is risk. And it is okay to be uncomfortable with risk. It's okay to be even more than uncomfortable, to be afraid. That's why some people hire an advisor. I feel like I operate with robot-like execution with clients, but even on myself, I don't. And let me give you an example, Jesse. During this downturn, I don't have a lot of cash. I don't keep a ton of cash on hand. My biggest asset is the firm that I'm a part owner of, Plan Corp. I fund all my retirement accounts. I fund my health savings account. And so the best thing I could come up with was directing my entire paycheck to my 401k. So basically like speed funding my 401k while the market was down. And typically I wait to fund my HSA until December, like when I get my year-end bonus and I have a little bit more cash. But basically I just took all my paychecks and just put them right into the market. When you do it in a 401k, as your listeners and you and everybody probably knows, it goes right into the market. My HSA had to make a couple stops. And Jesse, we're recording this on June 10th. The cash in my HSA is still not invested. I am human like all of the rest of you. And all of the systems that I have in place for myself that generally mean that money's getting invested right away don't apply to my HSA, in part because of like the way the account's set up, and in part because it requires me to click a button. Now, is it because I'm afraid? No, if I'm being perfectly honest, I saw a little spike and in my head I said, well, surely most bear markets don't resolve themselves this quickly. And here it didn't. Now, what am I waiting for? I've not publicly shared this story. I guess by December, when I normally would have made the contribution, I will definitely do it by then. Maybe I'll do it right when we get off the call. In fact, mark my words, I'm going to do it right when we get off the call. My 2025 investment will get invested. So by the time you are listening to this, dear listener and the audience, it will be done. But my point, kind of going all the way back to your concern, was I think it's valid. It is very human. We all feel it. And when people like you and I are telling you what's best, what we have set up for both your clients, or we have set up for my clients, is to do it without emotion and to do it without human judgment and follow processes and financial theory, because the long term, those things work out pretty well. But the problem with the long term is that it is an eternity to live through in the moment. And so for the people who still feel uncertain and shaken about what has happened and what might happen, I will again reiterate for the third, fourth time in the past 5 minutes, totally normal. Just remember, why is it that we invest, and what is a risk that you get compensated for, and what's a risk that you don't? You don't get compensated for trying to time the market. You don't get compensated systematically, at least, for trying to pick exactly the right security. So even though I poorly timed the market here, I'm going to go buy the single fund that I own that's 100% stocks, globally diversified. I will make no choices other than what my predetermined plan is. And you go forward that way. One of the crazy things is you look back at every drop and it seems like an obvious opportunity in hindsight, but it's always seems like a risk in the moment. And so find a way to turn what feels like a risk into an opportunity. Because I can assure you that when you look at one of those long-term charts that goes up and to the right and has all the headlines, this is just going to be one of those headlines that shows up on the chart of long-term returns, despite all of these headlines. This is going to be on that chart. Give us a year so there's enough room on the chart to include it, and it'll be in every history book like that.
You touched on a few things there, Peter. Well, first off, I want to say that your quote, that part of our job and part of any investor's job is to grow their assets faster than inflation without undue risk. I'll be honest, I've stolen that one from you before and used it. That is a fantastic explanation of the reason why we're all here in the first place. It's not to become gajillionaires and die atop the greatest pile of gold that we can. It's to simply grow our assets faster than inflation, but also keeping risk in mind, which is huge. I want to dive more into behavior because to me, when I've seen what's happened so far this year, one of the biggest risks we all face as individuals is that risk of overreacting. It's that risk of mistaking volatility for some sort of signal that we need to change our plan. I'm pretty sure, correct me if I'm wrong here, I think I listened to a podcast episode that you put out earlier this year where you said something akin of, there are some times actually where you suffer volatility, maybe for the first time as an investor or the first time as a retiree, your portfolio really takes that first big drop. And you learn that maybe your risk appetite isn't quite what it is. And changing your portfolio actually is the right thing to do. It just so happens that it was also the right thing to do before the volatility hit. You just didn't realize it. Can you dive into that logic a little bit?
It's interesting, and I don't think it's something that I would have said at the start of my career nearly 2 decades ago, when my only education was really that from a textbook. In reality, when you're dealing with humans, you can't take the human nature out of humans. And I think a lot of times as we work with clients, it's not just to be a robot fact machine. I mean, many instances, we have the unique privilege to listen like a therapist and ask questions and dig deeper. What I've come to learn as a result of that is nobody really has a problem with the volatility itself, with the down market. We'll sign an investment policy statement before we invest a client's assets, just like any other good advisor will do. And you'll say, hey, the portfolio, the worst 12 months it's had, like if you had $1 million, would you be comfortable losing $360,000 of it or whatever? And you're like, yeah, of course. I really think people believe that. And that's how we set that stock bond mix. But what I've come to learn is that while people can handle the volatility, they can't necessarily handle the narrative. And I think that's a very different piece of the pie that has given me a different appreciation for what my job is as your portfolio Sherpa. I'm not just here choosing investments. I'm going to think a lot about the experience of investing. And if that means that we didn't dress you warm enough for the winter, we're going to get you an extra layer of coats, which in this case, I guess, are bonds. I don't know. This is off the cuff here. Or if you're too hot, we're going to get you some swim trunks. In a perfect world, the market's down and you find out that you're too conservative, that you're in your 70s and you have more money than you're going to need. And so you're going to more closely align your portfolio with the time horizon of those who are set to inherit it, and you get more aggressive in a downturn. But if you're approaching retirement or having just entered retirement and you realize that you can't handle the downturn, it's not ideal to sell while markets are down, but it is much better to adjust an allocation a little bit than to go to all cash. There is no doubt that getting entirely out of the market is the wrong move. Naturally, when people want to make such a move, I remember in the years 2007, 2008, 2009, that was a very common conversation. I want to get out of the market. Everything is going down. Everything's going down in flames. And we used to call them jumpers. They're jumping out of the market. Now, jumping off a building, but to call them jumpers. I was working in an office that had no individual offices. We were in a totally open floor where all the founders and partners of the firm were dispersed equally among us. And so you could hear all the client calls. And that to me was a very different vibe, trying to make sure you don't get all the way out of the market. Whereas if somebody's a 60% stock portfolio and they want to go to 50-50, in the grand scheme of things, it's not that big a deal. If it will help you sleep at night, it's not that big a deal. And I'm going to reluctantly say, oh, by the way, if you really want to make a change that's going to make a real difference in the long term, you should probably make a move by more than 10%. But I don't know that that's necessarily what I want to see people do. I recognize that 10 percentage point changes aren't going to really change your trajectory that much. And so as a result, if it's really going to help you sleep at night, that's fine. What I like to do in those instances is document it really for the benefit of the client. The best traders in the world, and we're definitely not traders, but they keep journals. They have their reasoning why, what would make them change their mind, and just create an archive of, hey, this is what I heard during our conversation and why you want to make this move. And the reason you do this is because if it fast forward 6 months or 6 years and the sentiment's totally flipped, We have to make sure that we have a clear roadmap of why we got to where we were for making these changes. You're allowed to make changes with your portfolio. In a perfect world, you pick one strategy and one allocation, you stick with it for as long as possible. But at the end of the day, if you can afford to make that change, yeah, you're right. I think I've become a little more lenient in my sentiment around that issue.
You remind me right there, there's this Cliff Asness story that maybe you've heard before, where I think it's his aunt or his great aunt. I think she lives in Australia, but she travels back and forth to, I believe it's the USA pretty often. And she knew that Cliff Asness, listeners, if you're not familiar, he's a hedge fund guy. So she would ask Cliff, hey, I know you do these currency trades or whatever it is you do. When's the right time in any given year when I need to move my Australian dollars to US and US to Australian? And for years and years and years, Cliff was like, I can't tell you that. I can't zoom into it this specific day. And she interpreted that as, you're just withholding information from me. You know the answer, but you're withholding from me. And so eventually, he said he kind of got this better EQ, emotional intelligence. And he'd say, you know what, Aunt Cindy, next Wednesday. You should do it next Wednesday. Because she got the narrative that she wanted, which was she was getting expert advice. And Cliff realized it's all just arbitrary anyway. Telling her next Wednesday isn't any worse than telling her, I don't know. There's a similar, not maybe exactly the same, but there's a similar idea that you just described there, Peter, which is if someone is 60-40 right now, they feel like they have too much risk, going 55-45 or 50-50 makes them feel better for the rest of the year. Okay, all else equal, it's probably not a coin flip. I would rather they stay 60-40 if that's better for their plan. But if it does help them sleep at night, it's close to being a coin flip, and I'm okay with that change. And it's a lot better than saying a month later, screw you, Jesse, you told me I can't change, and now I'm going all cash, like sayonara. It's a much better outcome. There is this interesting gray area. I also wanted to touch on the narratives idea a little bit more, because one hard thing that I find, Peter, is I'm certainly not a fake news conspiracy, they're all lying to us person. But at the same time, I do realize that if we consume too much news, whether that's cable news or just reading Google algorithm feeding you the news that you're already reading, it is easy to convince yourself that the narratives will start driving your portfolio decisions. One of my struggles, or just one of the hard parts I find about answering reader or listener questions or answering client questions, is when they say, but haven't you been paying attention to the news? Everything is going badly. It was the case when President Biden was in office, and some people were saying everything is going badly. And now it's the case when President Trump is in office and everything. And it really is largely narrative driven. Maybe I'm beating a dead horse here, but what do you say to the client who's addicted to the news and is telling you that you're wrong about the world?
I experience those same conversations, and I try my best to always, anytime the conversation comes up with a concern, the first question I ask is, how do you think that impacts earnings? Because at the end of the day, the stock market tracks earnings so closely, shockingly closely. I mentioned working on this book. It's become such an important idea to me that it's almost an entire chapter. And there's some charts in there that you'll be able to see how closely it's all tracked. And the economy and the stock market are not the same thing, because the economy, they're real people losing their jobs. Businesses, they have access to sell to the whole world. Now, are things worse because of a set of policies than they would have been otherwise? Perhaps. I think that's a logical concern. But does that mean that earnings won't continue? Let me put this a different way. So I own a stake of the business that I'm in. I'm not selling my business because of the way the world is going. We're trying to figure out as a business how to earn as much money as possible. All of my clients who are business owners are doing the same thing. The front end of my career was mostly with doctors. When I came to Plan Corp, it introduced a lot of business owners into the type of people I worked with. I've never, ever, ever met a business owner who says, I'm going to just sell my business because the economy's terrible. I'm just going to sell my business. What is it that we all think we're doing in stocks? We own businesses. And that's where it's a narrative correction. What's so interesting is so many times people give me all these reasons that things are bad. I'm like, those are all facts, but they're not necessarily relevant. That actually comes up with the investment case for a lot of things. We don't have to go down a huge rabbit hole. One topic that I really struggle with, for example, are private investments. Maybe they're useful. If they're free, I'm all in, but I don't think they're necessary. The primary narrative for using them are all facts. I'm just not sure they're relevant. When you come to things on policy or the economy, all facts, all something that I think might impact you in real life. I think especially in the last 6 months, the thing I've been reflecting on is, hey, this is the sort of thing that's going to affect our everyday lives. but it's long-term not really going to affect the way that businesses, in the sense that they try to make as much money as they possibly can. If we get to a point where businesses stop trying to make money, that is a massive problem. I don't really see that happening. If the U.S. consumer, they say, well, they have to sell to the U.S. consumer. If the consumer's worse off, you're like, well, they might be worse off, but maybe they're going to go sell more in a different country. Well, aren't those earnings less because of all the tariffs? Maybe, yeah, but they're still going to try to make as much money as they can. This is not the first obstacle that businesses have faced. And so I think going back to like these narratives of the economy is looking bad, and look, to be clear, actually, the economy is showing mild signs of strain. What does that mean? Nobody really knows, because some economic data doesn't read out the same way it used to. It all goes back to earnings. And that doesn't mean that you can't have temporary declines in earnings, but generally speaking, as long as you think companies will keep trying to make money, earnings have historically grown more than inflation. A lot of that's because when there's inflation, the businesses pass on the price increases and then boom, you got higher earnings. Well, then it's a matter of, well, some companies earn more than others because new markets are created. Think of like NVIDIA, the chips that are needed to run AI programming. Those were a market for the last 10 years, but boy, did they become an important market in the last year or two. And what's pretty crazy about the stock market is less than like 5% of stocks drive all the returns basically in any given year. And so it's not that every company needs to do well. And maybe that's something I should have led with. You get me talking long enough, I'll get to the points eventually, but let's just go strictly with tariffs. There will be winners and there will be losers. The winners might win so big that the losers, it doesn't really matter. They might more than make up the earnings lost from some of the smaller companies. And oh, by the way, some of these losers in the total stock market make up less than 0.1% of it. So it's not to say there won't be winners and losers. It's not to say that there won't be winners and losers in the real economy. And those are real concerns. And I feel really bad for a lot of people who this impacts. And I'm going to say this, I hope the audience doesn't take it the wrong way. I mean, one of the things about the policies recently, as well as all of the policies since the great financial crisis, are that if you are an owner of financial assets, you're probably in pretty good position. So does that mean it widens the inequality gap? I'm not an expert in this space, but my intuition would be yes. If you're worried about being able to meet your own financial goals, I would say that as long as you're a holder, because again, we're just trying to outpace inflation here. That's the first principle why we're investing. If you have financial assets, a lot of these things, maybe your assets won't grow 15% a year like they did for a while there. That was unusual. That was not normal, but you're probably going to be okay long term.
That's always an interesting one to touch on, Peter. I've struggled with it as a content creator over time, whether it's writing or podcasting, where we do notice things where we say, boy, this particular tax law, it might make wealth inequality worse. Or there's some things I know in like the financial independence movement where you say like, wait, you could retire with millions of dollars, artificially show very little income and get totally free healthcare? I mean, the answer is yes, you can. It's difficult for us in our positions to fundamentally change policy. If someone wanted to ask us, we're free to give our opinions there and say, yeah, these policies aren't necessarily fair. But at the same time, if our job here is to give the best advice we can to the individuals listening, there's something to be said where people who own income producing assets have tended to benefit from that ownership, potentially to a disproportionate amount. Okay, but still, you're better off owning them than not. Maybe we'll leave the philosophical discussion to another podcast or another episode. On the topic of recession, the one thing I wanted to touch on with you, and again, neither you nor I are PhD economists. You must
No, definitely not PhD. I got a major in economics, but I don't think that even makes me remotely an economist.
At least you...
That makes me a college graduate.
You can speak to this question probably better than I can, though, which is through a lucky circumstance, last week, I got quoted in the Wall Street Journal, which was, wow, big honor.
Very cool.
And the article was about recessions and the fact that, as you alluded to, some of the data is looking a little weak and millennials might start living through what's our third recession. The first one being the great financial crisis, which was potentially one of the worst recessions the world's ever seen. The second one being COVID, which reminded us that anything can happen and pandemics are real. And now a third one might begin. But the question I have for you is, does every recession have to be a great financial crisis or come along with something like a global pandemic? Or is it possible to have a more vanilla recession?
It's one of the reasons that a deep understanding of history, economic and market and financial history can be so helpful to so many advisors and even individuals who have lived through these periods. They were at a point in their lives where they had less money and didn't care, or they've forgotten, or they never really realized what was happening in the first place. Recessions take on all shapes and sizes. Also, just for the record, a recession doesn't mean that there's a bear market in stocks, and a bear market in stocks doesn't mean that there's a recession. Often, a bear market tends to precede a recession. 2022 is a great example. Had a bear market in stocks, no recession alongside with it. You kind of had this intermittent weakness in different sectors of the economy. There was a really good term for it that's escaping me at the moment, but that's okay. A recession doesn't have to be a crisis. Recession, to me, if you're going to try to simply categorize it, you think job loss. Recession, you're typically going to see a lot of job loss. That can bring some real life implications and really shape what your worldview is. So if you mentioned a millennial, if this is your third recession and you lost your job in each one of them, you're going to be really afraid of recession. If you're a millennial who did not lose their job in any of the recessions and maybe even got to invest opportunistically, you're also going to view recessions in a very different light. When you are thinking about recessions, to me, it's less about your portfolio and more about your balance sheet. And I tend to think of the two things differently myself, in part because my portfolio is so boring. I already kind of referred to it. I own one fund that's 100% stocks. I don't have any taxable dollars, it's just my business. One day I aspire to have taxable dollars again, but in general, my balance sheet has different risks in a recession than my portfolio does. My portfolio is all retirement accounts at this point. I don't need the money. I'm 40 years old. Let's say I don't need it for 20 to 30 years. A recession has zero impact on my portfolio. A recession on my balance sheet is a little different. I have some leverage tied to the commercial loan for the business that I own. My business is tied to the stock market. So if the stock market's down, my income's down and my cash levels are low, suddenly I have to think about balance sheet management a little bit more. I'm just talking about my own situation, but if you're listening to this, think about your balance sheet. Think about the cash that's on it. Think about the long-term liabilities, whether it's a mortgage or student debt or some kind of commercial loan. Think about your portfolio, both retirement assets and otherwise. And how would a recession, how would a change in your income stream impact your balance sheet? If you're near retirement, it could a lot. And I think that's a very valid concern. I won't make it sound too draconian, but a less than ideal scenario for somebody about to retire is that the first year that they're in retirement, there's a down market. It's not the best thing to have happen because you have to withdraw from your portfolio and you do permanently impair the portfolio's earning potential by doing that. So what you might do if you're going into retirement is start building up a cash reserve so that if there is a recession, one, it won't delay your retirement. So I've seen that happen before where people are like going to retire in a given year and then there's a recession. So they hold off retirement for another 6 to 12 months. Well, like, look, you don't get to push out your life expectancy to 6 to 12 months. So I view that as not good financial planning. I view that as a missed opportunity. Having the cash to live through your first recession without needing to draw through your portfolio is a really good preparation point. Doesn't have to be something that's built overnight, but it could depending on the way that you retire. If you have pensions, you're a little more recession proof. If you're below the age of 50, your portfolio is probably recession proof. And when I say recession proof, not that it's immune to losses, but you really don't need to worry about it. And so again, kind of going full circle back to my original statement, I tend to think more about how would a recession impact my balance sheet than my portfolio. And if you are retired, I think the same is true. Yes, you should have a portfolio that is built that assumes that you're going to have downturns, again, with a similar magnitude and frequency as you've had in the past. And so you've tested it in a Monte Carlo analysis that shows, yes, I can make this withdrawal in a down market. You should be good. Now it's just a matter of managing the rest of your life. You don't have to worry about losing your job in retirement because you don't have a job. Do you have to worry about your kids losing a job and how you might respond if they do? These are the things that I would be talking about more so than, is my stock bond allocation right? Should I have more international instead of more US? Do I need to make changes to where my cash is held, et cetera?
I want to touch on one of those things you said right there, but real quick, you did mention the sequence of returns risk. So listeners, I want to point you to back on episode 87, we had a deep dive on the sequence of returns risk that's worth checking out. But right there, Peter, you just mentioned one of the questions you might ask is, should you think about your international versus domestic holdings? The last question I want to pepper you with today, as far as 2025 so far, has been this interesting, at least short term, maybe it'll stay, short-term change in international versus domestic stock returns. What have you seen out there? What kind of conversations have you had? I've had some, going back to the news narratives, I've had some people who, especially in the downturn of April, said, well, let's just go 100% international now. So I thought that was a fun conversation to have. What are you seeing out there?
Yeah, what a reversal from like the past 15 years. So for context, I started my career in the summer of 2007. And basically every year through the financial crisis into like 2011, 2012, when the US debt was downgraded by S&P for the first time, everyone was obsessed with owning more China. People did not want to own US. US was the worst. We should own all international, more international. The past 10, 15 years, people have said, why do we own international? We should only own US. And Jesse, I had my first conversation with a client a few weeks ago saying, I want to shift from the US to international. So it's finally happening. I'm thinking, gosh, I can't wait till international outperforms so that I can stop having this conversation. But silly me, I forgot that then people just want whatever's outperforming. And I'm not making fun of anyone listening who feels that way. This is just our job. It's hard not to laugh at it. And I think in general, let's go to the simple, why do we own international? There can be different reasons. I'll tell you why I own it, Jesse, is I own it for diversification. I don't own it necessarily for higher returns. What is good about diversification mathematically is if we have two portfolios with the same return and one has lower volatility and one has higher volatility, the one with lower volatility is going to compound at a better rate and as a result have a higher compound return. And that's like your real life money. You want high compound returns. Your average return that you see on Morningstar of a fund doesn't really matter. What did it compound at? So if the two returns are the same, but one is lower volatility, you want the lower volatility one. And that's what diversification does. Now, in reality, you do give up a little bit of return by owning a global portfolio versus just an all US portfolio. But the corresponding reduction in volatility is great enough that that compound return is attractive enough to diversify. So today, when people are thinking about, should I switch from one to the other, you're kind of remembering why you do it. And the research will show that you get that diversification benefit, that reduction in volatility benefit from owning anywhere between 20 and 50% non-US stocks. The problem with the research is nobody knows what the magic number is. I would tell you, you pick a number and you just stick with it. If I were a gambling man and I had my gun to a head and I had to bet what's going to have higher returns over the next 10 years, US or international, I'd say international. But you know what? I would have said that each of the last like 4 or 5 years too and been wrong. I'm a really big proponent of pick a percentage and stick with it. Now, let me share one other quick narrative because I know we're running long and I apologize. I'm a wordy guy. I remember being at my former firm, the year is 2011, and we're looking at the return data set. The MSCI data starts in 1970. And so like 1970 through 2011, the returns of an all US portfolio were identical to the returns of a global portfolio. And so we increased our international allocation and all the reasons showed that we should do it at the time, but then you fast forward and wow, did we make a bad decision? And actually a friend of mine who has a similar role at a firm, similar size as us, did the complete opposite this year. They had been overweight international for so long because the valuations suggest, much like I just said, that international should outperform. They had been overweight international forever, and then they switched to overweight US at the beginning of this year. Exact wrong timing. So you find a percentage between 20 and 50% of your portfolio and don't change it. We happen to be at 30%. Why are we at 30%? I'll be honest, Jesse, this firm was started over 40 years ago. I don't know why we did it, but I'm in charge and we're not changing it. Is there data that could make me change my mind? Of course. You give me 200 more years worth of data, which I know I can't have, but let's say I somehow magically could. I'm open to changing my mind, but I think I've now watched too many instances of the timing getting wrong. We already know that we can't predict the future. Why would this situation be any different? And so if you're sitting in your globally diversified portfolio thinking that you want to move more into international or even go all international, even if you're right, you're going to have to figure out when to switch back. And chances are you're going to be wrong, not because I'm making a prediction, but just because we are all terrible at timing the market.
Peter, you are always a treasure trove of good investing thoughts, and that answer is just another example of that. 2 final questions for you. One being, let's let the listeners know where they can listen to you on a more consistent basis. But then the second one being, remind us a little bit about the timeline and the topic of your book that you're working on right now.
Thanks for the invitation to share. So my podcast is called The Long-Term Investor. So you can go to thelongterminvestor.com or you can search The Long-Term Investor in your podcast app. The new book you can learn about by going to, drumroll, theperfectportfoliobook.com. It is due out, I think, in July of 2026, but that last URL I shared, if you sign up for that, you are not on my normal email list. You're going to get early access to chapters. You are going to get some special offers for like signed books. There's going to be some subscriber-only webinars and whatever else my marketing person comes up with between now and then. I'm going to do a lot of behind-the-scenes stuff so that you can get a sense. I know when you sign up for the newsletter, you get 3 automatic emails over 3 days, and then you get on a regular update. But you get an excerpt from a chapter pretty quickly, and you get the outline of the book. And I'm going to share chapters in full when they're publisher approved and done. And so, yeah, would really appreciate anybody checking that out and follow along. And just like on this podcast, you comment, you subscribe, you like, you follow. Those are like what help other people who are passionate about these topics like you. You're listening to us right now. It means you're passionate about this. When you review Jesse's podcast or you review my podcast, it helps other people like you find us. So we both appreciate when you do that.
100%. That's totally true. Well, Peter, thank you again for stopping by Personal Finance for Long-Term Investors.
Yeah, Jesse, thanks for having me.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.